Good afternoon, everyone. Happy 2021. Thank you so much for joining us on another Wednesday afternoon webcast. Today, we will provide you with a brief market overview, and joining me is our President and Chief Investment Strategist, David Burrows. At the end of this conversation with David, we will, of course, have an opportunity to address your questions. I know we've had a few roll in already. So if you would like to ask a question, please don't hesitate to hit me up on the Q&A or chat via Zoom or via email, phastings@barometercapital.ca. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pamela. Nice to see your face. Thanks. I want to thank everybody for joining in today. Boy, 2020 is done, and what a year it was. If there was ever a year where you needed to have a process, you needed to be a good seller, you needed to have some repeatable tools, it was the year. Because if we'd made decisions based on our gut instincts or based on what we thought should happen, it would have wound up being a very difficult year. So what I'd love to do today is just have a quick run through where we are now, how we got here, and some of the things that are changing in the market, because the market is always an ever-changing thing, and our job is to understand some of those changes. If I boil down to what I think our clients expect from us, is it's easy for anybody to go out and buy an ETF on the S&P 500 or a broad-based fixed income ETF. But at the end of the day, I think that if you hire a manager whose job is to actively make decisions and try and put you in the road of some good ideas and some key themes, I think that our job isn't to be everywhere. Our job is to have some tools to identify the most constructive parts of the market, the areas that have a tailwind, where structurally they are benefiting from the conditions that we're operating in. And that could be specific geographic regions, it could be specific industries, it could be different asset classes. We need to find the market leadership. And we need to focus in those areas. We don't have to be everywhere. Actually, usually there are some broad parts of the market that are anchors that we'd like to avoid. And so I think really we're getting paid to sort of pick our spots without any bias and use the process that we have to do that. We also have to always watch for change, because it's really easy to get vested in a view when you're investing. You do the work, you do the research, you make an investment. At some point on every one of them, you're going to have to change your mind. And if you get too caught up in your view, the market can leave you in the dust. And then there are some times when nothing works. And I think that as a successful investor, you have to have an ability to be on the sidelines at certain points in time, or certainly out of big parts of the market, to manage your risk. And so when I think about what we do, we're selling a very tactical strategy. The portfolios look really different over time. Sometimes they'll look similar for a long period of time, and then in a short period of time, we'll go through a major rotation. But we've built a team to kind of do that. I think most people know we have a belief we have been in a structural bull market in stocks since 2013 in the US. So this is a long-term picture of the US stock market. And we know there have been a series of structural or secular bull markets, each one driven by some structural change in the economy, where over a long period of time, it was kind of 4 steps forward, 1 step back, pullbacks, and they are certainly painful, but they're over quickly. And at some point, the asset class winds up overowned and overpriced. And you have to go through a long wander through the forest while money leaves that asset class in favor of other things that are going to treat investors better, until ultimately the asset class is underowned and hated, and it starts again. And so this is the bull market from 1981 to 2000. Then it was over. In 2000, in fact, we were only running equity money up to that point, and it became clear to us that we were headed into a period more like 1966 to 82. And income security started to look very attractive. We thought maybe certainty might be better. There were some income trusts and things in the Canadian marketplace that were very attractive. And so we set up our second strategy, which was our income mandate. And that treated us really, really well for the 13 years where the S&P went nowhere. And then ultimately, stocks broke out again. And we've been rallying for 6 years. And certainly, we've been focused in equities. But not all equities. Canadian market was kind of sloppy over the last few years. Global stocks, certainly sloppy over the last few years. Emerging markets, sloppy over the last few years. So again, it comes down to geographies and asset classes and so on. So US stocks is the S&P, in a bull market since 2013, continues on, has certainly had pullbacks, but continuing to look attractive. The NASDAQ broke out in 2016 and certainly was very, very strong through most of last year, and certainly continues to be in a bull market after consolidating for 16 years after the peak in 2000. When we look at fixed income rates, we have been in declining interest rates really my entire career. I started in 1986, rates started to peaked out in 1981 and been falling ever since. So most of the people I know have lived their lives during falling interest rates, and certain things do really, really well during falling interest rates. The difficult thing is at some point rates start to rise, and different things work well in a reflationary environment than in a disinflationary environment. So again, it's about recognizing changes, and we think there's something changing significantly in the rates markets or the fixed income markets. Commodity prices have really long rises and really long declines. On a relative basis, commodities have been really a horrible place to be for many, many years, at least a 10-year bear market. And we think something's changing there. So we talked to lots of people who would say in the last 10 years, why would you ever buy commodities? And it was not the thing to do. But they're still thinking that today, when in fact maybe something has shifted. So let's talk about rates for a minute. This is the yield in a 10-year bond, which bottomed probably generationally in March of this year at about 50 basis points, half of 1%. And, certainly that was for good reason. The world was being flooded with stimulus. There was real concern. People were looking for a place to hide in a scary time. But since then, we've seen a slow increase in the 10-year yield. This morning it was at 1%, up about 50 basis points, or twice the yield it was at in March. So when we look at bond prices, this is on the 20 and 30-year bond, peaking out in March. So people buy bonds largely for security and safety. And if you're only getting 50 basis points, but your bond goes from $178 to $152, doesn't feel so good. And if that's just the beginning of a shift, a generational shift in yields, well, that could go on for a long time. Now, we know that when stocks rolled over in 2000, some people stayed in tech stocks for the next 3 years through a bear market and got crushed. Some people were good sellers and were gone by March of 2000. You have to be prepared to recognize change. And we think we're going through a significant sea change from a disinflationary world to a reflationary world. Now, it's not helped by the fact that there's a ton of bonds that have to be reissued in 2021. $5.8 trillion of the bonds in the US come mature, which means they have to sell bonds to replace those. That means you hope to have buyers. Now, interestingly, the Chinese have been aggressively marketing their sovereign debt around the world. Their currency is relatively strong. Their economy is growing. Their bonds yield 2% more than a US Treasury bond. It is significant competition. And the holdings of US Treasuries by global central banks and global players has been falling now for over the last couple of years, more quickly over the last couple of quarters. So the Fed has been the buyer of last resort, and that's something we have to keep an eye on. Commodities also, we think, are going through a shift. Commodities in general have been falling since 2008, 12 years ago, and are going through a rotation. It started actually in early 2020, and COVID hit, and I'm going to say delayed that response. But given all of the stimulus that's been pushed into the system, monetary and fiscal stimulus, and given the fact that people are starting to look through the pandemic to what that stimulus might do to global economies around the world post-COVID, demand for commodities are expanding. So bonds weaker after many years of strength, commodities stronger after many years of weakness, bonds overowned by investors, commodities generally hated by investors. I think commodities are a lot like stocks were in 2013. Not many people wanted to hear about it. Within commodities, metal and mining has been stronger. So gold and silver probably the strongest, base metals second strongest, agriculture quite strong. Why might some of this be? Well, central banks around the world are printing money. 21% of all of the US dollars in existence were printed in 2020. So when you're printing currency, it's like taking a pizza that used to be cut in 8 slices and taking the same pizza and cutting it into 12. You get less. And so investors around the world have started to take dollars and buy productive assets that might hold value better. The central banks have been stimulating around the world. Developed markets have significant debt on their balance sheets relative to GDP. And so the US dollar is falling. So US dollar is falling for a couple of reasons. One, it's a safe haven. People tend to go there like they did in March and April for safety. But if they believe that the currency is going to get devalued and the rest of the world is improving, they'll take those dollars and buy productive assets. And we think that this is also an important shift. Now, in red is the US dollar as a percent of global foreign exchange reserves. In other words, the reserves that governments hold in reserve to complete global trade. And you can see that the US dollar as a percent of the total foreign reserves has been falling, meaning they are choosing to hold other currencies, maybe Chinese yuan, maybe euros, but the dollar generally follows that. So there may be a little catch up here. We think the US dollar looks weaker. So you want to own things that do well when you get a weaker dollar. Now, in December, I pointed out that bonds versus stocks, after giving virtually the same return since 2000, have started to significantly weaken versus stocks, and bonds are very broadly held. When we look at the stock market, we pointed out in December, 63% of stocks had a dividend yield higher than a treasury bond, yet dividends grow. Now, if we think rates might rise over time, long-term bond yields, then investors who are looking for yield need to have things that can pay a higher yield over time. And that's the great thing about stocks. You find the right ones, their dividends grow over time. A big source of return is the dividends and the growth in the dividends. An example might be Home Depot that's grown its dividend 25% a year over the last 5 years. So in the very short run, stocks are one thing you want to own if you think that there could be weak currency or reflation. And the S&P, I think, confounded us all with this very strong rally off the lows in April. We pulled back a little as we normally do through September and October and into the election, and have rallied coming out of the election into the fact where ultimately we're basically at new all-time highs. In the NASDAQ, it's a similar picture, although stronger year for the NASDAQ than the S&P. Those are the two strongest markets. So treasury bonds weaker. That means within the market, things that act like bonds aren't very attractive either. So while rates were falling or bonds were strengthening, people did very well owning things like utilities and telcos and REITs. We know when there's a lot of stimulus pushed into the system, price earnings multiples tend to go up. There's a very high correlation here. Well, there's been so much stimulus pushed in, and even more likely to come with the Democrats in power in the US, price earnings multiples can continue to rise. There have been times where multiples were much higher. In the early 1970s, the Nifty 50 stocks traded at 70 to 90 times earnings. While we haven't seen that in our lifetime on dividend-paying stocks, it happened then. Equities relative to bonds, as far as their earnings yield or the return they're getting in earnings versus the yield in the 10-year bond, still are very attractive to long-term averages. So there is good value in stocks. Now, we use breadth-based models to try and find leadership in the market. What do I mean by that? When we head through a cycle, when you go through a decline, the weakest securities sell off first. As the sell-off picks up steam, stronger and stronger securities are impacted until late in decline, people are selling the very best stocks along with the weak ones. When the most aggressive folks decide it's time to put money to work, They don't buy the weakest securities first. They buy the ones they perceive to be the strongest. So often the leaders turn up first. And as a market strengthens, the buying spreads to more and more securities. So broadening market, meaning more and more securities participating, is healthy. There's no bear market in history ever happened while breadth was expanding. And similarly, the strongest stocks don't sell off first when it runs out of gas. The weaklings sell off first, the ones under the surface that people maybe aren't focused on. But if enough stocks start to roll over, sooner or later it gets to the stronger and stronger stocks, and pretty soon they're all heading lower. So in our breadth-based models, where we look at the relative health of whole markets, whole geographic regions, whole asset classes, industries, we would say from a stock perspective, Canadian stocks, US stocks, global stocks are seeing expanding breadth. When this starts to contract, that's an alarm bell for us. That's what causes us to start to reduce our risk. Now, in the very short run, some stocks were consolidating, meaning some started to fall below their 50-day moving average in the US and globally. But in general, our short-term and long-term indicators are strong, and especially the long-term indicators trading right at the highs. But they can trade up to 70, 80, 90% of stocks in uptrends, where right now we're 50, 60%. Now let's go back to this concept of reflation. When we came out of the Second World War, developed economies on average had debt equal to about 125% of their GDP. And that was the peak. And it was very hard to carry that debt. So what did they do? You can either pay it down, you can raise taxes like crazy, which they also did, or they can try and inflate the value of assets to offset the value of the liabilities. And that's what happened. In the early 1950s, asset prices started to inflate or reflate. And we're in a similar spot today. We've taken on so much debt, there really is no alternative but for the Fed and for governments to try and create asset inflation through their policies. When that happened in the early 1950s, rates started to rise and stocks started to rise. From 1951 to 1966, stocks went up 15% a year. Except because rates were rising, they offset the coupon, and bonds gave a 1.6% return for the next 15 years. Stocks and bonds since 2000 gave relatively the same return until this past year. And when you start into reflation, bonds will significantly underperform and stocks will significantly outperform. You need things that have an ability to make money in rising rates, which stocks do. So there's some parts of the stock market that don't. REITs, for instance, this was the high in March. They've never got back close to the highs because they are long life assets, real estate, that have a long life contract with their tenants. When the economy strengthens, their rates don't go up a lot. And so people buy them for the yield. Same with utilities, not even close to going back to the highs. High dividend paying stocks, those ones with high dividends but stable dividends, just didn't perform last year because people started to look through the pandemic and what this stimulus might do. So as opposed to owning high dividend stocks, we chose in our income strategy to own dividend growth stocks, lower dividends, but dividends that are growing. So from 1951 to 1966, this was the best part of the market. It hasn't been the best part of the market over the last number of years. But we want to own things where when their earnings improve because the economy strengthens, their dividends go up, and it's a self-fulfilling process. So what else do we want to own in a reflationary environment? We want to own what I'd call short duration assets where their business cycles are very quick. Semiconductors are the best example of that. Companies don't buy and store semiconductors for months at a time. They get them just in time because it's a high value product. They're constantly being improved, so there's high turnover. When the economy gets strong, prices go up. The prices move dramatically. And semiconductors are clearly way outperforming the market and have all year long. Software, on the other hand, and technology is less economically sensitive because people sign up to a contract to pay by the month. And as a result, software recently has been underperforming. Taiwan Semiconductor is a great example. They make chips in Taiwan. They make the ARM-based chips that are going into the new Apple devices. one of the strongest semiconductor manufacturers in the world. We own companies like Applied Materials, and we own companies like Lam Research that make the equipment to make semiconductors. So what else is doing well? Well, consumer discretionary companies. Consumer has more money and stimulus is helping. There's a broad range of companies within the consumer discretionary space that continue to perform well. And with more stimulus, there will be more impetus in that area. We talked in December about how we had seen the first big boost to money going into global equities we'd seen in a long time. So we saw improvement in our global breadth models. We talked a little bit about that. But this is the emerging markets ETF. This was the low in April, and they've just absolutely taken off. Now, a big part of emerging markets is China. The Chinese market, after being in a bear market from 2015 through this past fall, have broken out, much like US stocks did in 2013. This is the beginning of a new bull market. And within the Chinese market, certain sectors, certain better, like consumer. We talked about Taiwan breaking out after going sideways since the year 2000. That's a new bull market. Japan stock market breaking out for the first time since 1991, 30 years ago. And the Korean stock market breaking out for the first time since 2008. So global developed markets and global emerging markets, a new area of market leadership. This is an area we're paying a lot of attention to in our global strategy. 30% of the assets are in emerging markets. 20% of the assets are in global developed markets. Very different than the last number of years, but very strong contributors. There's the Chinese consumer discretionary sector. What else do we want to own with a weak US dollar? Well, lots of people have been talking about cryptocurrencies. We highlighted, this is a chart from our December 15th presentation. Bitcoin in its first big rally went from about $2 to $1,000. Why is that? Well, the thing about cryptocurrencies is there's only so much. There will only ever be 21 million Bitcoins. There won't be more printed after that. Currencies around the world seem to have unlimited printing. So people are using Bitcoin as a store of value. It then consolidated, and in its second move went from $600 to $16,000 and then consolidated. And it was very close to breaking out as we talked about it in December. And here we are a little while later. Since December the 15th, Bitcoin's gone from $16,000 to $35,000. And this is likely to carry on for some time. So in the fall of this year, for the first time, we added Bitcoin to our portfolios. What else does well with a weak dollar? We talked about gold having made a big turn and trading back toward the highs. Since then, gold has traded back to the highs and exceeded the highs. Again, another asset starting a new bull market. This is likely to go on for years. Silver, very similar. So the gold miners and the gold and the silver miners also starting a new bull market, but in fact, they're still lagging the metal, and they are as inexpensive relative to the metal itself as they have been since 2000, the beginning of the last bull market. There's the silver miners. So basic materials or commodities are an asset that you want to own if the currency is weakening and if you're in a reflationary environment. Why is that? There's fixed supply. Right? Copper has been a bear market for 10 years. There have been no new big copper mines built during that period. In fact, companies that worked of cutting their costs. And now that the global economy is picking up steam and the demand for copper is picking up, there will be a deficit of copper for years. And interestingly, in electric cars, you use 5 times as much copper as you do in a traditional gas-powered car. Freeport-McMoRan, copper and gold, is the largest position we own as a firm. They produce both copper and gold. It's a global player in providing really strong returns. Rio Tinto, I talked a little bit about in the fall, having traded sideways for 8 years. The last time this happened, stock was close to a 10 times return in the next cycle. So look, these are all pieces of a portfolio. Agriculture also as a group has broken out of a long-term bear market. Again, a group that is not well followed, but companies like John Deere, the chemical companies, the seed companies, the fertilizer companies also looking very strong. In the industrial space, the big machinery companies look very strong and look to be beginning a bull market. When you look at companies like Caterpillar or Ingersoll Rand. And certainly within industrials, there are some new age, more structurally benefiting sectors. Certainly automation and robotics is one of them, and they have led off the bottom. You know, energy is behaving better, but solar much better. We've talked about solar over the last year. In transportation, the rails are performing particularly well. These are all economically sensitive companies where when their business picks up, their ability to raise price picks up and their ability to grow accelerates. These are companies that benefit in a reflationary environment. Financials, you know, the US banks are still trading as a group below the highs from 2008, but there are some, the winners, the ones that restructured most quickly, that are trading at new highs. We always want to follow the leader. The first one to break out is the first one to continue to lead. So thematically, over the last year, we have been systematically rotating our portfolios to own things that are more economically sensitive, despite the fact we knew we would head into a very difficult winter from a COVID perspective. But the old adage is you don't fight the Fed. And when every central bank around the world is easing, and when ultimately you're likely to find a solution to the problem, like the vaccine, markets will look through it. Our holdings aren't terribly different from where we were in the middle of December, because I think we're fairly early on all of these themes. We don't need to make a lot of changes. Our big weights are technology, industrials, financials, materials. We have exceedingly low weights in things like utilities and government bonds and consumer staples and real estate. So our portfolio looks very unlike the index. Canadian dollar is strengthening. And so just to touch on that, so everybody knows, in the pools and funds that we run through the course of the past year, we have been hedged back to Canadian dollars, meaning that while the US dollar holdings may be doing well in US dollars, if the US dollar is falling, that would hurt us. But we've hedged all that back to Canadian dollars, so we're getting full benefit. And we think that that's likely to continue because the Canadian dollar tends to strengthen when commodity prices are strong. So we were fortunate, we had a very good year. Our equity fund was up 42%, did very well versus a blended benchmark of the S&P and the TSX. The long short portfolio had quite a stellar year, up 47%. But you can see as the back half of the year happened, the reflation holdings really started to kick in. And most of the funds and pools are up anywhere from 4 to 8% in the first few days of the year. The income portfolio, because it was in more dividend paying securities, did better than the bond market and did better than the high dividend paying stocks. But dividend growth really has started to kick in over the last few months as we went from underperforming to outperforming. And really in all cases, the pools and funds did very well on a relative basis during the decline, giving up about half the decline now. Our models are positive. We're fully invested. We will be happy to get beyond some of the binary risks that President Trump brought to the market, waking up on a Tuesday morning to a tweet that would change the world. But we do watch every day for deterioration in our breadth models. If that should take place, we will not hesitate to get defensive. But we think this shift in major themes is something that is likely to go on for several years. Reflation could go on for 10 to 15 years. And there will be lots of rallies and lots of corrections, just like in every other market. But we think we're positioned well to take advantage of it. So as we go into this year, we are very happy to be in 2021. And we just hope that all of the change in the US happens peacefully. We hope that the virus is wiped off the face of the earth with the vaccines. We hope that everybody stays safe, and we look forward to a good year. So Pam, if there's any questions, I'm certainly happy to address them.
Thanks so much, Dave. We have one question here. If you could just address, we have mentioned dividend payers and dividend growth, and it's an area that we like to be positioned in. One of our investors is just curious if the U.S. election, the results with Biden taking presidency. I apologize that I have a puppy, so he's making some squeaky noise.
Apologize on that.
I want to grab the squeaky toy, but apologies. The question is about how the election could be beneficial to dividend payers now that there's a Democrat in office, or it's a Democratic administration.
So look, certainly there's pluses and minuses in any election. And, one of the things that we all are concerned about is the potential changes to the tax regime in the US. Given the fact that the split in power is so evenly balanced, it's going to be hard to see anything radical take place. But I think one thing is clear. It has been a long time since we had both fiscal stimulus, meaning driven by the government, putting money actually into the economy, as well as monetary stimulus coming from the central banks at the same time. We all know that stimulus takes time to actually get into the economy. And all of this stimulus is going to be roaring into the economy around the time when we are getting through the vaccine. And it's not just the US, it's around the world. This is not just a US issue. But certainly it's more likely that we will get more fiscal stimulus in the US given the Biden win, and that will likely be good for markets. Now, the positive to all this is for those of us that are fortunate to have assets, we can buy productive assets and benefit. For those that don't have assets, reflation is a difficult thing because ultimately it can turn into inflation, prices go up, and you hope that wages go along with it. But in the short run, the biggest risk, I think, right now is one that people aren't used to thinking about. It's that cash is being aggressively devalued. And so we need to own things that can keep up with the reflation or be ahead of it. And I think that by owning some of the structural themes that we talk about, we can do that. And dividend growth is one of them. But it's going to be very important, I think, to examine the types of dividend payers that you have, because if they're dividend payers that don't participate in a strong economy, then it's going to be hard to get much dividend growth, and that would hurt. I mean, it would not be unreasonable to think that the yield on a 10-year bond could close the year or at some point this year be at 2%, 100 basis points higher, 100% higher than where it is now, which means bond prices fall.
Dave, next question. If you could just comment on Canada. In light of the U.S.
Sure.
election, we spend so much time focused on the U.S., but we don't often talk about the Canadian side of that story.
Sure. So let me see if I can just do that for you just for a second. The Canadian stock market until this year went nowhere since 2014. And I think that what people don't realize is that the Canadian stock market acts a lot more like emerging markets than it does like the US stock market. The makeup is quite different. We do well as a country when commodity prices are strong. We don't have a big healthcare industry. Our consumer discretionary industry isn't that strong. We've got lots of interesting mid-cap companies. The political situation in Canada has not been all that favorable for international investors. But when the commodity cycle starts, the Canadian dollar firms up, and people know to come to Canada to buy commodity stocks like Teck Resources, like like some of the gold producers and some of the silver producers, like some of the agriculture companies. So the kind of environment we're headed into is good for the Canadian market. Canadian market could outperform US stock market this year. And certainly the Canadian dollar is likely to be strong. It's not that the Canadian dollar is so strong, it's that it is stronger than a weak US dollar. So Canadian banks are likely to do well. Canadian resource likely to do well. And that could be really great for the Canadian indices. We're sort of rifle shooting and picking our spots. A lot of the new investments we're making are in mid-sized companies right now. We've had some tremendous success over the last few months with mid-sized companies. We were in a market for 5 years where all you really had to do, if you were in retrospect, was own Amazon, Apple, Google, and Tesla. I think we're in a different kind of market than that right now, and likely to for the course of the year.
Thanks, Dave. Another question here about copper and your views on copper as a commodity and where you think that commodity will price as we move through 2021.
Yeah, look, copper, it used to be, we called it Dr. Copper, because copper could tell you what was likely going on in the global economy, because it's a product that goes into so many things. And certainly semiconductors have taken over that role as being the best indicator. When semiconductor orders start to dry up or the economy starts to slow down, the orders drop very quickly because no one wants to carry that very expensive inventory. But copper is still still that as well. And interestingly, after 10 years of being in a bear market, and the companies that produce it even worse, copper is in short supply, and the Chinese have been stockpiling it. There have been really no new production come on in 10 years. And so the world is likely to be in a deficit. So if you think about it, the reason that commodities do well in a reflationary environment is if demand picks up, there's only so much supply. The last dollar of demand sets the price for everybody. If you're in the desert and there's 10 people and you got 9 bottles of water, how much is the 9th bottle of water worth? And so copper is likely to be one of the things that really participates in this market. And so there's Canadian companies and global companies that we can participate in.
Dave, sorry about that. Dave, final question for today, potential corporate tax changes. You touched briefly on them. How do you think, and the corporate tax changes in the US, how do you think those will impact corporate earnings and stocks going forward?
I think it's going to be very hard for there to be any significant change in the next 2 years. We're going to be digging out from this pandemic for a while. And I think if there's going to be change in taxes, the most likely candidate, sadly, in the US, the very wealthy will likely pay more tax. So as they call them, the millionaires and billionaires will likely pay more tax. But I wouldn't expect major changes from a tax perspective in the next 18 to 24 months for anyone, because they're too busy trying to make sure that the economy is really on a roll, and they don't want to derail that right off the hop.
Thank you so much, Dave. That concludes our questions for today. If you have any additional questions that you might want to address offline, we're always happy to speak to them. You can email me at phastings@barometercapital.ca, and we will see you and David next Wednesday afternoon, same time, same place, in your living room or office, 4 p.m.
Wouldn't we all like to be in our offices? Thanks everybody for joining in, and look forward to talking to you again next week.
Thanks, and Happy New Year again, everyone. Take care.